we have with us an incredible panel. I'll take a quick minute to introduce everyone, starting from the left. Kimi is a founding partner at 8VC, co-founder of women's health and wellness company Monthly Gift. She served as a director at various companies in healthcare, lifestyle, and fashion spaces. She's a mentor and advisor to Venture for America and a senior advisor at Cornell Tech. We are very lucky to have you with us. Second from left is Oded Hermoni. He acts as a bridge for Rhodium's portfolio in the Valley since 2012. Oded is an investor in 25+ companies and has founded 2 of his own startups, one of which was acquired by Yellow Pages in 2006. Oded chairs the Israeli Entrepreneurs and Founders Forum of Silicon Valley and is involved with many angel clubs. Thank you, Oded, for being with us today. Sheil is the CEO and founder of Amplo, a venture capital firm focused on investing in the most impactful young entrepreneurs globally. He's on the board of Andila, #1 most innovative company in Africa. And as an angel investor, Sheil is invested in early rounds of Casper, Fiscal Note, Robinhood, and others. Thank you for being with us. And finally, Carol Sands, founder and managing partner of the Angels Forum and the Halo Fund. She has over 20+ years of experience in early stage investments, teaches angel investing and board governance at Stanford University. Thank you, team, for being with us today. Audience, I just wanted to make sure you're feeling comfortable with the link to questions and answers. We are going to use Slido. If you have any questions, please post them up. You can go onto the website, sli.do, and put up questions. The code is WISDEM. If you're feeling very brave, please come up to the mic, and we will hear you live. Without further ado, I'll begin with the panel. So, as Priyanka said, VC valuations are the hotness. We have, on one end, companies raising Series A at $1.6 billion with Zoox, raising $250 million. And on the other hand, we have what we call traditional rounds, raising about $5 to $10 million at 30 to 70 million valuations. Panelists, how would you say between early stage investing and late stage investing, and Kimi, you've done a lot of late stage investing, walk us through what does the cap table look like? What part of the cap table is given away? How should we get our hands around understanding the valuation?
Sure. Hi, everyone. Thanks for having me. So I would say the main difference between early and late stage investing, and this is something you probably, a lot of you know, is that you're using real data to value companies as a company matures. And so at the later stage, you have a lot more information to be able to understand how a company should be valued. At the early stage, you're really trying to understand the market size, and that's how, that's the main, metric you're using for valuing a company, and then the team's experience and such. But there's less information, obviously, to go off of, so it's a little bit more art than science, I like to say. I'm not sure if everybody agrees with that or not, but feel free to jump in. There's a lot of investing talent here. And then in terms of what the cap table looks like, I think this varies a ton, so it's it's hard to say. But I think that as you mature, you should be giving away less and less of your company as you're raising later rounds. And so maybe in your earliest round, you can expect to give away sometimes up to 30% of your company. That would be a lot. And then as you grow and you're achieving your milestones, you can expect to give away less and less, no more than 20% in any round, and probably if you're lucky, less.
Right. And Oded, we were chatting about it earlier, but how would you say early stage, like going from seed to Series A? How do you come up with that number? What does that magic formula look like?
So, thank you. Very much related to what you said. When you're going to raise your first round and then the following one, you should always keep in mind how much you are being diluted. Sometimes in seed you're trying to raise money and you're being so much diluted that you are not attractive anymore in A round because you're losing more than 40, 50% of your equity in the company, and the investors assume that down the road you won't have any incentive to stay in the company. So investors look for happy or win-win situation with the entrepreneurs, definitely around here. So keep this in mind. So when you're starting your seed round, it's usually a cap, a note with a cap, or a safe that was both, I think, were invented by YC. It's a very pro-entrepreneurship agreement. And the concept is, let's just do it simple so we can just start working together. In A round and B round and C round, then things become a bit more complicated, and the valuation become more critical how you measure it, because you have different feedback. But in the seed round, you're usually being measured by the market. So I can tell you that it's runs between $4 to $10 million cap usually for early stage companies. It will be on that spectrum. When you look at B round, C round, it will be anywhere. I mean, it can go to 100 and can go to 1 billion. So it's much wider spectrum.
Got it. Should entrepreneurs be presenting valuation guidance? Is there a VC way to do this? Sheil, you've been an entrepreneur before. Would you say that raising money with a guidance typically tends to land a higher valuation, or should they leave it up to the experts?
I've found that often entrepreneurs have a number in their head, right? And it's better to just put that out there at the beginning, so everybody knows the range that we're talking about. Otherwise, we can get in a situation where I, as a venture capitalist, might think one number, the entrepreneur might be 50%, 2x, 3x higher, in which case, if we're not going to ever meet at a proper number, what's the point of continuing the conversation, So I just had breakfast this morning with a founder. He told me he had leverage. Okay, I didn't have any leverage. He had leverage.
How so?
Because he was raising a large seed round, and the seed round was, I think, almost fully subscribed. Almost fully subscribed. I think there was, a couple $100K left. And he said, this is the cap, take it or leave it.
Wow.
So I actually respect that. I respect that because it saves everybody a lot of time. And it says, this is the valuation, whether you agree with it or not. And now let's talk about the company, but here's what you would have to invest at if you were interested.
Right.
So the counter is that if the valuation gets too far in front of the company's actual performance, then you have a disaster that's going to happen. And I want to be really clear. That disaster impacts the entrepreneurs first. First of all, the most likely thing is the founding team gets taken out of leadership and maybe is allowed to stay in the company, but definitely taken out of leadership. And the next thing is that the amount of shares that you own in a down round are cut dramatically. And one of the things that people don't talk about is this whole concept of valuation from the entrepreneur side. Everybody's focused on, I want a really high valuation because that's bragging rights. That's stupid. You're not doing anything for bragging rights. If you can't turn that into cash for you and your investors, then you're focused on the wrong things. So the valuation has to have some level of sanity applied to it. And there are tried and true industry standards based on if this is what your performance is, this is the reasonable valuation. And the minute you start breaking that, you're putting the whole company and your personal investment in the company at risk.
Right. That makes a lot of sense. On the valuation front, Carol, would you say, as entrepreneurs go and raise money, is valuation the decision factor when you're deciding which VC should I raise money from? What are other things they should consider? I could go get the highest term sheet, but
why would you want it? I mean, the highest term sheet is not the unit of measure.
Right. What is the measure?
So the unit of measure should be who's the right venture fund that's going to be helping me as an entrepreneur and me as a company to be successful. What are they bringing to the table that's in addition to money that I need and want? And many times that means you're going to not take the top valuation. The reason that people are over bidding is because they really want that particular company, but they know that all things being equal, you won't pick them because they don't have the value, the extra value that companies need and want. Somehow in Silicon Valley specifically, we've lost sight on the value of the investors to the growth process. And we've been saying to entrepreneurs, oh, you're so smart, you're so perfect, you don't need our help. And in fact, many of the venture funds that have been started are based on not providing help. They're just providing money. And I get that. Every entrepreneur needs money. But you also need the experience and wisdom of experienced entrepreneurs and experienced investors to help you get through those tough times.
Switching gears a little bit, you know, if entrepreneurs are thinking about moving from the seed raise from this morning, Sheil, to the Series A raise, what are the biggest points of growing up that need to happen when you're going from raising a seed round to a family round to Series A? Because I think Series A is kind of the big league. You know, you're ready to make a splash. What would you guys say?
Well, it sounds like you have some thoughts too, so I'll get to you. You know, I would say often so I used to run the seed practice at NEA, and one of the things that I noticed is that sometimes entrepreneurs would come to pitch for the seed. We would give them a seed investment, and then the exact same team would come for a Series A with no improvement on the executive team whatsoever. And I was like, all right, so, you know, is it just going to be the two of you guys, or just one of you, or three of you forever? Or are you planning to hire this VP of X, or this, you know, C of X, or this executive that's going to be really solid, and this team around you? And so I think that's one growing up that folks have to do, which is recognize that it's not going to be just one person or two people forever, you know, and you need to build that team up as soon as possible, and ideally hire folks who are going to be smarter than you.
So first, just for your first question, before that, just about how you pick the fund. One of the common mistakes I see is that entrepreneurs go to large funds or top-tier funds that are mostly on B and above, and they try to raise from them seed money because it's sometimes easy because it's a spray and pray. You need to find the right correlation between your stage and the right investor. Because if you go to a huge fund, like NEA, for example, when you're in the seed stage, the amount of time that they will spend on you is the same as they invest on a $100 million deal. So you won't be the focus of their work if you raise only $500,000. So if you come to them on the right stage, then you will benefit from having this kind of a big fund. Just about seed to A, keep in mind that higher valuations sometimes in seed, when they are not met with the status of the company following that, might hurt you. So if you're raising with a very high valuation on your seed and your A round is not supporting your valuation, you might face a down round. And sometimes it's not about you. Sometimes it's just the market is shifting. And like we had in November 2 years ago, that the market just went down suddenly. Thanksgiving, people just didn't come back from the vacation for about 6 months. And suddenly companies faced a lower valuation without anything that was related to them between their seed and their A. So the A was equivalent to the seed. So keep this one in mind.
I would just add that between your seed round and your Series A round, I always look for two things in founders really making that transition, and it's something that I continue to look for as they grow into further rounds. And so it's a lot of things that break up into two buckets that you can draw, and this is to Sheil's point, you can draw incredible talent to your cause, like to your company, and you can create unfair advantages for yourself. And so I think a lot of times when you're shifting from your seed stage to your Series A, you're trying to make sense of how to get a higher valuation, how to make sense of that, to Carol's point. And I think that if you can show that you drew in talent when you were still small, there was not proof you're going to be around a long time, but you can bring, heavies to your company, I think that's really important. And then I think that you can show that, you really used every tool in your toolkit to build to build to where you were, whether that be important relationships for your company, early customers, things like that, really show those two elements. I think you'll have, really no problem going into your Series A.
Thank you. That makes a lot of sense. On the point about valuations, so valuations is the denominator, and the numerator is how much money you raise. And Reid Hoffman famously in Masters of Scale last week said that there's nothing like raising too much money. You should always go for as much as you can and build a war chest. What do you guys think about that? Do you think that's the right way to do this? Is there anything as raising too much money?
I think you need to think always ahead what will happen if there will be a shortage of money or it will be hard time to raise money. So you need sufficient money to be at least 18 months ahead when you're early stage. 18 months is I think, the number. Yeah.
I also think it depends on the company and what you're trying to do. I think there's some companies that you can project out what your sales are going to look like. You can project out 18 months of costs, but you might have huge market forces that you can't really predict. Whether that's huge multi-billion-dollar players in your industry, and then I think there's every case for building a war chest. And I've given my companies the same guidance. They're out raising 20 million and they raised 90 because they could, and I would almost all of the time think that's a crazy idea, and I think it's too much, except for in the case of if it's a huge healthcare company and their competitors are multi-billion-dollar revenue companies, then I think it makes sense. But otherwise, I would agree. I think there's such a thing as too little. And we've all seen that before, but I think that the too much, I think there's a line. I think there's some companies there is, and some companies there isn't too much for.
So I think that this is really a conversation about what stage the company is at. If the company is still in the, here's my concept, really don't have any buyers of my product or service, I'm still trying to figure out how to sell it. I'm still trying to figure out how to scale it. I'm still trying to figure stuff out. I think it's stupid to take too much money. All you're going to do is, well, no, it's not that you're diluting you are diluting your cap table. But the bigger issue is that the probability of all startups is failure is the most likely outcome. Statistically, failure is always the most likely outcome. And if you take in too much money, what you've just done is close the door of being able to go back and ask that investor to invest in your second or third startup. So you want to be careful about your brand. I mean, at a later stage when you are in that go stage, maybe it does make sense to take as much money as you can. Personally, I'm still a little on the conservative side of that. But as an entrepreneur and as an investor, I'm very focused on one single question, and that's, will I make money?
Of course.
Well, you would think that. But there are lots of people who invest for something other than to make money, and there are entrepreneurs that appear to be focused on something other than to make money. And I just want to bring that back into the conversation. You need to know what you're going to do with that money. And if you can't figure out how to use $90 million, then don't take it.
Can I just add? You know, I had a company that raised way too much money in India. And when
How
sometimes...
much is too much in India?
They raised, I mean, over $1 billion. But, you know, in courses or in stages, they probably raised, you know, a couple $100 million at a time.
Got
And
it.
so the issue sometimes with raising that kind of capital is you feel forced to spend it. And so burn increases. And
In foolish ways.
in foolish ways. And so what I found in that company is marketing spend increased, and eventually they had a day of reckoning where nobody wanted to give them money anymore. And so they had to pull back the marketing spend, right? And an interesting thing happened, which is the company continued to grow at the exact same rate.
Right.
So then we were like, what the heck is all this marketing spend going towards, you know? So sometimes you can become foolish if you raise too much money, but it really depends on the type of company
You
and
have to-
stage.
You have to be disciplined and a good steward of capital no matter how much money you're raising. And I think I think that would be, you know, my response if one of my, you know, entrepreneurs who didn't succeed came back and asked for more money. That'd be the question I was asking myself. Were they a good steward? You know, even though the company didn't do well, were they a good steward of capital? Were they disciplined? I think would be, you know, top two questions with them coming back.
Right. Please.
So there's no rule that you're raising too much, but if you watched Silicon Valley sitcom, there's a rule of sometimes you take just the valuation is just too high, and then you can't just stand behind it, and then nobody told me that you can take a lower valuation. So there's also that kind of thought.
So, thank you. We have a bunch of questions coming up via Slido. AV team, if you could get, oh, perfect. So the questions are up. I'm going to go start with one of them. We have a very international panel here. How would you say valuations are different between the US and other geographies? How is the VC community different? Are they greedier in the US? Which places are more entrepreneur friendly? Should I relocate and go raise money in Singapore because that's better capitalization? Thoughts?
Yeah. So you can hear my accent. I'm Israeli. We do see an arbitrage between valuations in different locations. So, for example, Israeli companies in general are about 30 to 40% down in the valuation comparing to Silicon Valley. So for an US investor, sometimes when he invests in an Israeli company and gets a very similar to Silicon Valley kind of team, then he gets it in a lower price. But we need to remember that the reason why the valuations are also high in the early stage in the valley is that the cost of the cost of employee in the valley is much higher than anywhere else. So you need to all the time fund them in order to have them. I know that anywhere else than Silicon Valley, the valuations are much lower than here. From New York to Boston to San Diego, Baltimore, and other places.
Why is that? Why do you think that's the case? Is this a macroeconomic thing?
Why in the U.S.? Or?
Yeah, in Silicon Valley, why are they higher versus New York or more competitive?
Yeah.
There's more capital and there's more tourist capital. So, you know, in general, I think valuations are driven up by, you know, by that mainly, but also to the second part of that question, I think this is the most founder-friendly area to raise as well, just because the ecosystem is so strong and the talent pool is so deep. I think that this is the most founder-friendly area, and I spend my time half in New York, half here, as you know, and I think that New York valuations are catching up, actually. I think that it's starting to level off.
But it's also about what you are doing. If you're in, let's say, ed tech, the chances that you will raise money around here, it's much lower than in New York or LA. If you're in healthcare, it might be here, might be in Boston, might be in San Diego. So it's also about the industry that you're focusing on.
I would also say, so just looking around the world, I think the valuations are frothiest right now actually in China. If you just, you know, read about some of the rounds that are being raised, at the valuations that they're being raised at, it's just obscene. And the second frothiest is probably Silicon Valley. You know, India went through a time where the valuations were crazy, right? I mean, if you look at the valuations for Flipkart or Ola or Snapdeal or some of these companies, they made no sense relative to their US comparables. That started to come down. I think Africa is still relatively affordable, although even the premium companies there are starting to see valuations that are in line with, Silicon Valley comps. I spent a little bit of time in Southeast Asia, and when I first went there, the valuations were very reasonable. But, they've had a couple unicorns now. Tokopedia just raised at a multi-billion-dollar valuation. And so I think around the world, the premium companies are getting emerging market premiums, which doesn't really counterintuitively make sense, right? Because you would think that if you're in an emerging market, the risk is higher, whether it's political risk or currency risk. So you shouldn't be paying a premium for those, but it's what I'm saying, at least.
There's a ride-hailing company in Indonesia, Gojek, that just is one of the latest unicorn members, but going through a similar dynamic in Indonesia. Lots of questions here, folks. Please feel free to come to the mic if you're feeling brave. If not, we'll follow the questions on Slido. Looks like the most popular question panel is, funded by the VC community, tech and access, how have they changed in the last 2 decades? How has the process of investing changed in the last 2 decades? And my editorial on that, what does that mean for the entrepreneurs? Is there something to be done differently from conventional wisdom and convention being built over the last 2 decades?
So, since I'm the oldest, so there have been some pretty major shifts over the last 20 years in the funding process. So, first of all, 20 years ago, we didn't have as many investment sources. The angel community at that point basically didn't exist. And so over the last 2 decades, across the world, the angel investment community, which is individuals who are investing their own personal money rather than institutional money, has come in, and that has allowed very early stage companies to obtain cash from more readily and from more geographically relevant sources. So that's probably the biggest trend. The venture community has also grown substantially. I don't remember the current stats, but the venture community literally went like this in terms of the number of firms over the last 10 years. And so the amount of people that you can go talk to has gone up significantly. The different investment philosophies have also increased, which provides something for everybody. But from an entrepreneurial point of view, what all of this does is reinforce this concept that as an entrepreneur, you need to be doing your homework ahead of time and figuring out who do you want money from. And because you have a lot of options, so who's the right kind of investor for you, and then send out invitations for that investor to explore you rather than trying to paper the world and see if somebody will invest in you.
Right. So sniper versus shotgun. The rise of VCs, would you say, is that because of low volatility in the public markets and LPs and institutional funds looking for returns? There's not much happening right now.
If they were doing it just for returns, they wouldn't be doing it.
Terrible asset class. we all still do it. But if you looked at it just on a returns basis compared to the other markets that most of these people are playing in, pound for pound, it's not a great asset class. So, I think that it's so interesting that, there's been so many new firms, but also so much diversity in the types of investors moving into the market. I always think it's really kind of strange. Like I would never just like jump on a computer and be like, I'm going to have a hedge fund now. But hedge fund managers feel like no different about jumping into venture. I think it seems easier, and but it's really complicated, and you have to be really disciplined, I think, to succeed in the market. But there's all different types of investors that move into venture. Kind of, I think because it's sexy and it's interesting, and it feels simpler because there's less. A lot of the time, there's like less analytics, especially at the early stage. But I think that makes it more complicated, not less.
So I think that there has been from a government monies coming into this investment sector, they've finally have gotten the message, and this has happened on a global basis, that if you want to create more jobs, you need to do that through an entrepreneurial push. And so on a global basis, what we've seen is angel investing going up. We've seen corporate investing going up. We've seen venture investing going up. And across the globe, the amount of entrepreneurial startups have gone up. And when you give an entrepreneur $1, the first thing they're going to do is go out and hire somebody else. So job creation from a government point of view has been wisely spent in this entrepreneurial push. But from an alternative to the stock market, I have a hard time making that argument.
Okay. We are in, please.
So I have a different kind of a question.
Would you mind using the mic, please? So everyone, yep.
So what if you're not ready to raise seed, but just want people to give you advice and be on your advisory board to run the idea? How do you go about that? Like when you approach, people like you, and you're coming to them saying, I don't need the money right now. I have an idea. I have validation. How do I go about it? Would people be ready to help you out in that stage?
So seeking an advisory council is an extraordinarily smart thing for any business person to do. I actually advise even corporate executives to set up an advisory council as a way of promoting their career. So instead of relying on one mentor, having an advisory council where you can go ask questions and talk through ideas before you present them is a really good thing to do across the board. So yay for the question. On a practical level, many people in the investment world will only spend time and energy with companies that they are either investors in or have a current interest in exploring. And so on a practical basis, if somebody came up to me and said, I'm not looking for money, I just want your advice, I'd turn them away just because I have limited time in the day. My portfolio gets a very large percentage of that time, and prospective portfolio companies get the rest, and there isn't time in the day to go much beyond that.
Also, just to add to what Carol's saying, I think you don't necessarily want investors as advisors, unless they have operational experience, in your specific area. I think the right people to look to as advisors would be people in your space who you've seen strength from before, who succeeded in whatever it was that they were doing that's, similar or in your vertical. And so I think a lot of people will come and say, well, I really want you to be an advisor. And I'm like, well, I don't really know anything about this space. It's not, I don't invest in it, and I've never worked in it, and so I'm not really sure why. And I think sort of wrongly, a lot of entrepreneurs use that advisory relationship as a kind of like a foot in the door to, where they think they're raising money. I think lots of people hear this idea like, oh, ask for money, you get advice, ask for advice, you get money. I don't think that's how that works with like really professional investors. So I would say seek counsel from those in your vertical who have experience in that you're looking for.
Just to add another note, that if you take a VC as an advisor and you put him into your deck, people will ask if he invested. And if he didn't invest, then there's a question mark.
Hi. Given that I think one of the stats we saw earlier was less than 5% of women businesses or VC-invested businesses have women in them, what's the one piece of advice you'd give to us in the room to make that different? And who in the Valley, in terms of VCs, are women-friendly?
I think probably Carol and I can take that question. So I think the number is 18%, right, of companies that are VC funded or founded or have women on the founding team. I think that's the stat. It's still too small, but it's not quite as bad as 5. Yay. I think that obviously the environment we've been in has been particularly focused on this issue over the past couple of months, which is, unfortunate for those involved or those women involved, but I think fortunate for us all moving forward to sort of shine a light on this issue that we've been kind of facing. I think as a female VC, you actually see an outsized number of female founders, which I'm actually always excited about. And so I think if you look at our portfolio, it's actually pretty balanced, which is unusual. But I would look rather than look for funds where you feel like they're female friendly, look for funds that are interested in the area you're building in. And I think the sort of wrong way to approach it is looking for female partners, which feels right because you're like, oh, I want to see somebody like me across the table, and I think that's been true of men and women entrepreneurs for history. But I think that a lot of times I end up seeing women founders with companies that have nothing to do with the area I invest in, and they're like, well, you're a woman investor and I'm a woman founder, so this is what we should do. And I'm like, you're approaching this wrong. Let me introduce you to some other investors, men and women, who are more familiar with the area you're building in and who invest in that space. And so I think that's the way we have to talk about this versus women looking for women or women looking for women friendly. I think that's going to continue leading to sort of that number, that gap of 18% of 100% of companies being female founded.
That's very well said. Thanks, Himi. We are running short on time, so we will make a last call for questions. There's a very interesting question here I'll start with that is very relevant to this conference. Is it true that women entrepreneurs more often make the mistake of asking for too little funding compared to their male peers? Is that a thing, or is this a myth? In your experience, listening to the pitches panel.
I feel like this is a tough question, but I think more or less the trend would probably prove that that's true. Like women raise less money per the same round, like a Series A to a Series A would probably show that the number is slightly less. And I think I think that's changing. I don't know if it's that I think it or I hope it. It's hard to tell. But let's say that that's changing. Obviously, and I'm not an investor in this company. Glossier just raised $24 million. That was a big round. It was a top female founded raise, I think, of the year. Is that right?
That sounds right.
I think that's
a lot
right.
of money.
Anyway, so really excited for Emily and her team there. But I think that what you should be doing is right-sizing. There's a lot of women in the room, which is so great. You should be right-sizing what you're asking for to what you need, sort of similar to what we've all been saying. Try not to underraise. And I think that you look smarter going in and saying, this is what I need to run my company. These are the projections that I've done, and really putting in the analytical sort of rigor to what you're asking for versus like, oh, I just need 2 million, or I just need 3 million. I don't need that much, and sort of trying to disappear into the like, it's a small raise, so it won't be, it won't be as hard, or I won't be looked at as I'm so crazy. All entrepreneurs are crazy. You have to be to believe in what you're doing, because the numbers show that most of us, I'm an entrepreneur too, will fail. And so I think just versus, asking the question, do women raise more or less than men per round, I think is the wrong question. I think the right question is, what do I need, and who's the right person to give it to me, and sort of approach it that way. I don't know if anybody disagrees or agrees.
I mean, as a guy, I'll say that men tend to raise too much money often. They tend to be wasteful. And about half my portfolio before I started my own firm was female-founded. And actually, the two companies that I've invested in as part of my new firm are both female-founded or co-founded. And I think they both raised quite a bit of money, but I don't think they raised anything more or anything less than they should have, So I completely agree with you. The right question is, how much do you need? Now, is it too much or is it too little?
Right. Panel, anything to add to that? If not, I was going to make a closing note. This has been great. Thank you, guys. Would you please let us know how to reach you in case the audience had money or advice, or a combination of both?
Yeah, you can always email me. I'm just Kimmy@8vc.com. It's really easy to find me. I always feel like people from conferences are always like, oh, I don't want to bother someone. I'm like, it's my job to look at companies all day, so you should feel free to reach out.
I'm totally with her. Oded, O-D-E-D-H, @rhodium.co.il.
My
And
Twitter.
LinkedIn, by the way. LinkedIn is also good.
LinkedIn, Twitter @ShieldTile. My email, s@amplovc.com.
So I prefer only email. I hate LinkedIn connections because I can't track that through to my, my funnel is based on email. Because I'm looking not for can we LinkedIn and then can we talk about my startup? I want you to talk to me about your startup and send me the investor deck. So I'm csands@angelsforum.com, but business plans @angelsforum.com, plans @angelsforum, they all work, so.
Thank you. And I'm at apurv@softbank.com. Thank you so much, panel. This has been great. Until next time, if you have any questions, please reach out to them. They love being bothered.